Hello everyone, welcome back again. In this video, I will try to show you how to solve an accounting equation. In my previous video, I have explained you the meaning of accounting equation, and I hope after going through that video, you have understood the concept of accounting equation. So in this video, I'm starting with a basic problem sum. So let us go ahead with the question. In this question, we have to prepare accounting equations on the basis of the following transactions. But before I show you the accounting equations, I would suggest you that you take a pencil and then try to identify the accounts which will get affected in each transaction. This is just a rough work so that we will know exactly how many assets account we need to open and how many liabilities account we need to open. So let me show you an example here. Let me start with the first transaction. Number one, Ravi started a business with cash. So Ravi is the owner here. He brings money into the business for starting the business and he has brought cash. So if you look from the business point of view, there will be two accounts that will get affected. That is the cash account and the capital account. Ravi has brought cash into the business, so the business is receiving cash. So cash will increase in the business. On the other hand, if we see the other account that will get affected will be the capital account, because Ravi is the owner, he brings capital into the business. So 50,000 rupees capital will also increase. So the two accounts will be the cash account and the capital account. So next, what we do it is with the pencil, we write the cash account and the capital just next to the transaction or on top of the transaction. Okay, let me show you the next transaction. Purchase goods for cash. In this transaction, the two accounts that will get affected will be the goods account and the cash account. Goods in accounting equation is represented by the stock account. We don't write goods account, but we write stock account. So the account that will get affected will be the stock account and the other account will be the cash account. If we look at this transaction, the goods are increasing in the business, so the stock will increase in the business. On the other hand, the business is paying cash, so cash will decrease. So the two accounts will be the stock account and the cash account. So the next to the transaction only, we write the accounts which are affected after this transaction, that is the stock account and the cash account. Similarly, if we go for transaction 3, sold to Ram on credit. Now sold to Ram on credit, sold here means sold goods to Ram on credit. So goods account will be represented by the stock account and the other account will be Ram's account, but Ram is a debtor, so we write the account name as debtors account. So one will be the stock account and the other will be the debtors account. Stock will decrease in the business because the goods are going out. So from the business point of view, if we see, the stock will decrease. On the other hand, Ram did not pay the amount, so Ram will become a debtor and the debtors will increase in the business. Now for transaction 4, uh, this is a credit transaction. I'll try to explain you why it is a credit transaction after some time in details, but this is a credit transaction. The transaction number 4 is a credit transaction. Now purchase furniture. The two accounts that will get affected in this transaction would be the furniture account. Furniture is an asset account, so one account will be the furniture account and the other account will be Janata Decorators. The business has not paid money to Janata Decorators, so Janata Decorators is the creditors. So the other account will be the creditors account. So one account is the furniture account, the other account is the creditors account. Furniture comes into the business, so furniture will increase. On the other hand, Janata Decorators is the creditor, so creditors also will increase because the business has not paid for the purchase of furniture. So the creditors or the liability will increase. So the two accounts in this case will be furniture account and creditors account, and we write this two accounts just next to the transaction or on top of the transaction with the help of a pencil. So if we have arranged that already, so this is how it will appear. I've already have explained you which are the accounts that will come into effect in each transaction. That is, for the first transaction we'll have cash account and capital account. Then for the next transaction we'll have stock and cash. The third will have stock and debtors. Fourth will have furniture account and creditors account. Now if we do this, we will know exactly how many assets account will require to be opened and how many liabilities will be required to be opened. So if we look to the assets, that means the accounts that we will need to open would be cash account, stock account, debtors account, and furniture account. On the other hand, the liabilities account that we'll need would be the creditors account. Plus, we also on the liability side, we have to open the capital account. So now let me show you the format of the accounting equation. This is the format that we have. So you will draw the format in this way, and on top you will write accounting equation. Then after that, in the first row, you will write assets is equal to liabilities plus capital. Then after that, in the first column, you'll write serial number, then followed by the transactions, then the account that we have already identified. That means we'll open the cash account, plus stock we will have to open, plus debtors account we have to open, plus furniture account we have to open for the assets. And for the on the liability side, we have to open the creditors account plus the capital account. Now let me explain you each transactions in details, and I will show you how we will present that in our accounting equation. Now this is the first transaction that we have. Ravi started business with cash. Now we will look from the business point of view. Ravi started business with cash of rupees 50,000. So Ravi is the owner. He brings in cash. So the business is receiving cash. Now for the business, cash is an asset. So cash will increase by 50,000 in the organization. And also Ravi is the owner. He invests 50,000 in the form of capital in the business. So even the capital also will increase. So the other account will be the capital account. The capital also will increase by 50,000 rupees. So when we present this transaction, the effect of this transaction in the accounting equation, so this is how we will present it. In the first column, we'll write 1. Then we will write a briefly the transaction, that is started business with cash. Then below the cash, we increase cash by 50,000, and below the capital column, we increase capital by 50,000. The other accounts are not affected in this transaction, so we do not enter any amount there. Then we can write the new equation. So this will be our new equation. Cash will increase by 50,000. Stock remains unaffected, so it will be 0. Debtors not affected, 0. Furniture not affected, 0. And on the liability side, we have creditors not affected, 0. But the capital has increased by 50,000 after this transaction. Before we go for the next transaction, we try to check the total of the assets. That means we will add all the assets. Since the other assets are not affected, so we can see that only cash is 50,000. So if we add all the assets, it's 50,000. Then towards the liability side, if we add everything, we will get here also 50,000. Now from here we can understand that our sum is correct because both the sides are equal. So if there is if both the sides are not equal, then we should understand that there is a mistake while filling up the assets or the liabilities or the capital. So we need to check that. So after getting a new equation every time, we should always check that the assets are equal to liabilities plus capital. So this is our second transaction, purchase goods for cash. So the organization, the business is purchasing goods for cash. So the goods will get affected and the other account will be the cash account. The goods is represented by the stock account. Now stock account is an asset for the business. The stocks are increasing in the business because the business is purchasing goods. So goods are coming into the business. So stock will increase. So assets are increasing. On the other hand, the other account will be the cash account, which will get affected. Cash is an asset. The business is paying cash. So cash is going out of the business. So this asset will decrease. So cash is going to decrease. So cash decreases and stock increases. So when we place this in our accounting equation, this is how we will show it. In the serial number, we write as 2. Then we write the transaction, purchase goods for cash. Then just below cash, we write 22,000 in bracket. In bracket means we are decreasing the cash. Then we increase the stock by 22,000. Stock increases and cash decreases after this transaction. Now we will get the new equation. Now we write new equation, and the cash was 50,000 before. It has decreased by 22,000, so our balance is 28,000. Stock is increased, has increased, it has affected, and then it has increased to 22,000. So cash is 28,000, stock is 22,000. Debtors is unaffected, so it is 0. Furniture is unaffected, so it is 0. Creditors not affected, 0. And the capital remains same as 50,000. Now again we will check the total of the assets. If we add 28,000 plus 22,000, we get 50,000. And if we check the liability side, the capital is 50,000, creditors is 0, so the total comes to 50,000. So both the assets is equal to the liabilities plus capital, so there is no mistake here. So we can go for the next transaction. Sold to Ram on credit. Sold here means sold goods. When goods are sold, goods account is represented by stock account, and it was sold for credit, so that means Ram did not pay the cash for getting the goods. So in that case, for purchasing the goods, Ram did not pay the cash to the business. So in this case, it is a credit transaction and Ram is a debtor. So the debtor's account will get affected here. Debtor's account is an asset account. Stock account is an asset account. So if we look the effect, debtors are increasing because Ram did not pay. So the debtors will increase. So this asset will increase. On the other hand, stock means goods are going out of the business, so stock will decrease, so this asset will decrease. So debtors will increase and stock will decrease. So when we place this in our accounting equation, we write the serial number as 3, then after that we write the transaction sold to Ram on credit, then stock we will decrease because goods are going out. On the other hand, Ram did not pay, so Ram is a debtor for the organization. The debtors have increased by 5,000 rupees. So the new equation is, we write the new equation, cash remains unchanged, the balance is 28,000, it has not changed. On the other hand, the stock which was 22,000, it has decreased by 5,000, so the balance is 17,000. Debtors has increased by 5,000. Furniture is unaffected, so it is 0. Credit is not affected, it is 0, and capital remains same as 50,000. Again we add all the assets. That means after adding 28,000, 17,000 and 5,000, we get the amount as 50,000. So towards the liability also the total is 50,000. So we can go ahead with the next transaction. In this transaction we can see purchase furniture from Janata Decorators rupees 2,000. So furnitures were purchased for 2,000, but this transaction is not clear whether it is a cash transaction or a credit transaction. In this type of transaction, for making an assumption, we have to see whether the name is given or not of the creditor. So Janata Decorator is the name which is given from whom the furnitures were purchased. So we can say that it is a credit transaction because the name of the creditor is mentioned in this transaction. If the name of the creditor is mentioned and the transaction is not clear whether it is a cash or a credit transaction, then if the name is mentioned for the creditor, then we assume that it is a credit transaction. But suppose if the transaction would have been like this, suppose they don't mention the name, then in that case we have to assume that it is a cash transaction if the transaction is not clear whether it is a cash or a credit transaction. If they write purchase furniture for rupees 2,000 and the name is not mentioned, then we will assume that it is a cash transaction. So here in this transaction we can see that furniture is affected, furniture account is affected, and Janata Decorators is the creditor, so the creditor's account is affected. Now furniture is an asset for the business. On the other hand, creditors are liability for the business. Furniture comes into the business, so this asset will increase. On the other hand, Janata Decorators, the business has not paid, so the liabilities are increasing in the business, so the creditors will increase, so the liability will increase here. So furniture also will increase and creditors also will increase by 2000 rupees. So if we present this in the accounting equation, we write the serial number as 4, purchase furniture from Janata Decorators, the transaction. Then just below furniture, we increase furniture by 2000 rupees and we increase creditors also by 2000 rupees as the liability increases. The new equation, this will be our final equation because this is the last transaction. So our final equation is cash is 28,000, it is not changed. Stock is 17,000, it is not changed, the balance is remains same. Then debtors 5,000, the balance remains same, but furniture has increased by 2000 rupees and creditors have increased by 2000 rupees and capital remains same as 50,000 rupees. Now if we add the total assets, we get 52,000, and if we add the liabilities and capital, we get 52,000. So the assets are equal to liabilities plus capital. So this is how we make the accounting equation, and I hope after this video you have understood how to prepare an accounting equation. Thank you.